You've probably heard a lot about options recently. It seems they're in the news every day, and traders have been using them a lot more in order to get a quick profit without putting up much risk. But do you understand what an options contract is, or the math behind options, or even some strategies investors use to mitigate risk using options? Well, if you don't, I'm here to help. Today's video will be the first in a series of 3 occurring over the next 3 weeks, where we will be going over the basics of options, the math behind options, and then some strategies investors use. I want to put emphasis on the word investor. This is not a trading channel. This is a channel to help you build a portfolio for the long run. So let's start off today with the bare minimum basics of options. No math, nothing too complicated, just the basics. Simply, an option is a contract giving the holder the right but not the obligation to buy 100 shares of a stock at a specified strike price. There are 2 different kinds of options. There's a call option and a put option. The call option is typically a bullish indicator. It gives the holder the right to buy an underlying security at a specific strike price. But a put option, which is more of a bearish one, gives the investor the right to sell the underlying security at a specified strike price. I'm going to take out the whiteboard and we're going to go over a little bit more of the basics, including what a quote looks like and what both sides of the options trade looks like, not just the buy side. So right here, we see a basic options quote. First thing you see is the strike price. This is the price you want to buy the security at. So let's say you're buying this option. The strike price is 20. The security is ABC Corporation. It's a call. It expires on September 4th. That's a key thing to options. They expire. You're buying a contract basically that lasts, it could last a week, it could last 2 months, it could last a year, but at one point it expires. So for this call option to be in your favor, you want to see the underlying security reach a price over 20 before the expiration date. But we will go into that in the math side of options next week. Let's just focus on the minimum here. So the expiration date, September 4th, and the premium you pay in order to buy this option, this stock at the underlying price. Now there are 2 sides to an options contract. There's the writer side and then there's the holder side. The writer gets the premium, so the writer receives this from the holder, but must act in accordance with the contract. And let's put some emphasis on the word must. The holder has the right, but not the obligation. The writer has the obligation to act in accordance with the contract. And the holder gives the premium, may act in accordance with the contract. So again, going back up to our example of a quote, I'm an option writer and you're the investor. So you want to buy this option, a $20 ABC call that expires on September 4th with a premium of $1. So you will give me the $1 in premium and I will give you the chance on September 4th to buy ABC Corporation at $20 a share. As the writer, I hope it never reaches $20 a share because I will just get to collect your premium. And that's I win the trade. But if the stock goes above $20 a share, I begin to lose money. But again, that's the math we'll go over next week. The holder wants the stock price to go over $20 because if it doesn't, they lose their premium. They lose that $1 they gave. So, going over again, for the call writer must sell at the strike price. So they get the premium, but if the stock goes at or over the strike price, they must sell the securities to the call holder who gave the premium and has the right to buy the securities from them at a specific strike price. On the put side of things, which is the bearish of the 2 options, the call writer gets the premium and must buy the shares from the holder of the option at a specified strike price who has the right but not the obligation to sell the contract. It seems very complicated, and it is, because these are derivative options and shouldn't be played around much for people who do not understand them. That's where I come in. That's where I hope I can give you a little bit of education to know what you're dealing with when it comes to options contracts. Next week, we'll go over the math. We'll talk about break-even price. We'll talk about when you win the trade. We'll talk about when the writer wins the trade. But right now, I wanted to focus on the bare minimum basics of options contracts. If you have any questions, feel free to leave them in the comments. If you have the chance, check out my podcast, The Trending Ticker. The link will be in the description. We go over financial news on a daily basis during the week, and it is a great platform to learn more about the markets. Follow me on social media, Parker_Friedman3 on Instagram, or The Notorious PF3 on Twitter. And of course, like, share, and subscribe this video. Next week, we'll be going over the math, so I hope to see you there.